Good morning, good afternoon, and good evening, everyone. Welcome to today's webinar, Powering Limitless Investments, the RWA Edge. My name is Ankit Shah. I serve as the Global Head of FinTech at GTN Group, and I'll be your moderator for what I genuinely believe is going to be a fascinating and timely conversation. Today, I think we are pretty much at an inflection point in financial services. Real world assets, or what we call today RWAs, are being tokenized and effectively being placed on chain, right? This is no longer just a concept confined to white papers and conference panels. This concept is actually becoming a commercial reality. And I think that the implications for brokers, exchanges, fintechs, and most importantly, end consumers are quite large. So, over the next 45 minutes, we're going to pull apart what this actually means, the opportunities, the friction, maybe even competition and collaboration. We have three people who are right at the sharp end of this shift. So, let me take this opportunity to introduce our panel. First, on the call today, we have Nick Saunders, who's the CEO of Webull in UK. Webull is a retail financial services provider that has been redefining how everyday investors access the markets. Nick brings the broker's lens to today's discussion. Joining Nick is Sagar Desai. He is the head of business development for Coinbase in Asia Pacific. Coinbase needs very little introduction as one of the world's largest crypto exchanges. Uh, they are operating across both the B2B and the B2C segments. Sagar is going to give us a bit of a view from an exchange's perspective on how crypto infrastructure is becoming the rails for RWAs. And effectively rounding out this panel, we have Kareem Bugle. He's the global expansions lead for Wise Assets. Wise has built its reputation as a world-class money transfer and cross-border payments platform. And Wise is increasingly a player in the wealth and investment space. So Kareem is going to help us think through what this all means for customers and for fintechs operating across borders. So welcome all three of you. We're delighted to have you here and thank you for giving us the opportunity to bring you into this webinar. All right, so let's dive straight in. Before we can talk about the RWA opportunity, I think we need to make sure everyone in this room, right, from seasoned crypto natives to traditional finance professionals that are joining us today, have a very clear picture of what tokenization actually is and why it matters. So Sagar, let me start with you, right? And I'm sorry to start with you, but in simple terms, what role does tokenization play in enabling a better investing experience for end consumers, and why now?
Yeah, for sure. Thanks, Ankit, and really nice having the opportunity to be on this panel. As Ankit mentioned, I represent the wholesale vertical in Asia for Coinbase, Coinbase's institutional business, and obviously, I see the tokenization theme play out really strongly over the last 12 to 18 months. To answer your question, Ankit, maybe to tackle the definition of tokenization in very, very simple terms. Tokenization is a construct that goes beyond just representing something in a digital receipt form. So it is not just a digital receipt. It is really the process of converting the ownership rights of a certain asset, like stocks, bonds, real estate, private equity, what have you, into a digital token that is then living on a shared ledger that is understood by both the buyer and the seller, understood or recognized by both the buyer and the seller of that particular asset. So essentially, you are converting that ownership right into an asset that now lives on a shared ledger and can also be programmed with a smart contract, which essentially means that unlike traditional securities, these tokens can have compliance rules, dividend schedules, voting rights, all embedded directly within the token, so that when and if there is a transfer of value that is required or transfer of ownership rights required, you can sort of program that within the token itself. So it's really incredible and revolutionary in the way ownership rights can be represented, and hence how the financial ecosystem can operate in the future. And there are a variety of different benefits associated with tokenization. Very simple, and I'm sure Nick and Kareem will have more to add on. But the fact that a certain asset can be fractionalized. So if you have a large real estate asset of worth say $100 million, it can be fractionalized into smaller denominated tokens, which can then be bought or sold by retail investors like you and me. The other possibility is also the 24/7, 365 liquidity, which obviously does not exist today, associated with, say, stocks or bonds, which are typically restricted to a certain sort of exchange hour time slots. The other thing is the ability to settle a transaction within a matter of seconds or minutes, as opposed to waiting for a T+2 settlement cycle, which is really the accept and the traditional model. And then more sort of if you really have to imagine what that world or what that future would look like, the ability to program these tokens in such a way where you can essentially, as an investor, use agentic AI to potentially rebalance your portfolios across different types of assets. Say, for example, if you want to sell your tokenized gold so that you can maybe invest a little more in tokenized equities, that could be possible when you have these programmable tokens living on a blockchain and available to you to sort of trade on a 24/7, 365 basis.
Interesting. So here, Sagar, basically we're talking about fundamentally lowering barriers to investing, bringing in, let's call it fractional ownership. You mentioned 24/7 surround the clock access, and bringing programmability as well, right? So that's definitely very interesting. Nick, Kareem, from your vantage point as a broker and a fintech product leader, where do you see the real advantage landing, right? And I would also say let's try to be a bit balanced here. Are there any disadvantages or risks that your customers would need to understand? Maybe Nick, if you'd like to go first, and then I'll hand it over to Kareem.
Just so, I think we can split the sort of advantage case for brokers like Webull up into sort of internal advantages, the internal uses for the technology and the client-facing side. Internally, we obviously see faster settlement particularly cross-border, as key to the future. I mean, the volumes have gone up since the US went to T1 settlement. If we can go to T0, especially for money market funds, that is a very, very clear advantage. It enables clients to have their assets invested in interest-bearing securities longer before they purchase securities. The client-facing side is interesting, but I think I wonder whether it's a little bit overcooked. So obviously, more diverse assets is absolutely key. If we can fractionalize and allow retail participation in land, physical commodities like gold and other IP, there may well be a market for that. We see the growth of fractionalized shares really take off in the UK, particularly when clients are able to construct their own ETF portfolios. And there's no reason to think that the same wouldn't happen with other assets. And on the subject of ETFs, I think the technology and the sort of growth of digital real world assets can lead to innovation in the ETF world. I think we may well see ETPs being constructed outside traditional assets. So we may see clients being able to purchase fractionalized baskets of collections of artwork, of wine, of land, of any number of things. So I think it makes diversification of portfolios much easier. In terms of notes of caution, The idea of 24/7 liquidity, well, I think liquidity may well be a misnomer there. There's a fairly limited pool of clients who want to access these diverse assets anyway. Splitting that liquidity up over 24/7 is just going to make them illiquid. The problem there is that people won't, an illiquid asset is not one anyone wants to invest in. So I think then, we need to be realistic about the amount of interest there is and grow the market slowly, and not get caught up in the idea that because we can do something means we should. I think sometimes it means we shouldn't, and we need to go more carefully.
That's an interesting take. Okay, and Kareem, what are your views?
Yeah. Hi everyone. I'm Kareem. I lead the global expansion of Wise Assets. Just a quick overview on Wise Assets is essentially the investment product offering that we offer to Wise customers on the platform. So it's mainly retail customer focused. Our offering right now is fairly limited in terms of asset classes. We're mainly focused on money market funds and mutual funds. So when I answer this question, I'm going to wear my hat of this is the current product offering that we are having live on the platform and how this technology could potentially help enhance customer value, right? So that's what we're really after. I think I think none of us here today are trying to launch tokenization for the sake of tokenization because the technology enables it. It's all about customer value and what it enhances on that front. Two things that we think are interesting on that front. One is the 24/7 settlement ability that was already mentioned today. So that kind of enables better capital efficiency also for us at Wise. And I can later on go into a bit more detail of how our current product works and how this could potentially be quite big for us. And the second aspect, which is a bit maybe smaller impact, is the ability to have continuous yield accruals on instruments like money market funds, where basically every minute or every hour that you invested, kind of you get the yield associated to it. You don't have to wait for the next day. Same thing about when you place a sell order, you actually continue accruing the yield until the moment you actually kind of the settlement is done on the withdrawal side. So that's also kind of like the two main things that we've seen being interesting in terms of the world of investment products that we offer today. We are in touch with our partners, infrastructure providers, fund managers. A lot of industry players are deep into the space, and we are kind of following what's going on to see like when are they going to crack one of these two pieces. And today, we haven't yet seen that that's the case. And there's a few blockers, right, which I'm sure we'll talk about later. But it is something we're continuously monitoring and could be very interesting for us in the future. I also echo Nick's point about liquidity. I think it's really, really important that we are very careful here. And when we enable things that sound great, but actually there's no liquidity behind it, it's actually detrimental to customers. Now, for specifically Wise's case, like the investment and the asset classes we offer are very liquid ones, so I don't think there's going to be a huge concern on that front. But as we expand into more asset classes, it's going to become an issue. So yeah, that's it from my side. Thank you.
Interesting. Okay, so yeah, I mean that's two interesting takes. One from an exchange's point of view and who's already in the tokenization space versus from a fintech and a brokerage point of view, who may at some point of time get into the tokenization space. So now maybe let's zoom out a little bit and at an exchange level, right? So one of the most exciting developments I think that we are seeing today in crypto exchanges is that they're actively bringing real world assets on chain. So equities, ETFs, bonds, real estate. This is a significant pivot. So Sagar, maybe we, in this case, this will be addressed more to you. How is Coinbase approaching this? How are exchanges like yours embracing real world assets? What does it enable for you as an exchange specifically? And what does it open up for the broader market? I'd also love your view. You mentioned a little bit about the AI agents in this context, right? So I'd love your view to go a little bit deeper in that, because that's one of the threads I think we cannot ignore as well. So if you can give your insights.
Yeah, for sure. It's a great question, and it is a question that we have internally battled for a few years now, because I entered this industry about 7.5 years ago, actually, through tokenization. We were tokenizing an investment vehicle way back in 2018, 2019. That was sort of my first foray into blockchain. So it's kind of interesting for me to be in 2026 answering some of the same questions that I was asked maybe 6 or 7 years ago, which also tells you about how hard it is to change the underlying financial infrastructure. I think from an exchange or a Coinbase perspective, the overarching thesis that we have, or we are operating with, is the fact that blockchain protocols are the missing internet layer for property rights. And the reason I say that is, once you have, now that blockchain protocols are real, and we have already seen how they can be scaled, you suddenly have the prospect of programmable instruments make finance internet native and almost unlock software-driven product design. And this world is this sort of futuristic world that is possible through these programmable property rights is something that we haven't witnessed at all until now. So nobody really can tell you how the world of finance will sort of look like in the next, say, 5 to 10 years. But that is sort of the overarching thesis that we are operating with. And that's the reason why we've doubled down our efforts in tokenization across asset classes. The implication of that is that growth, yield, and customization now are at the cost of software, all sort of powered by AI in some ways, if we sort of look into the future, say 5 years from now. And this sort of shrinks the surface area for us to sort of deliver financial products and really sort of puts us in the path of rapid innovation, all at the center of crypto plus tokenization, all sort of offered via an exchange. Coinbase is building across the stack. So obviously, from an asset class perspective, we are looking at equities, bonds, structured credit, loans, really informing the infrastructure for internet native global markets. That's the first vertical of how sort of Coinbase thinks about building products. The second vertical is really the distribution arm. And this is where partnerships with asset managers, partnerships with folks like Webull and Wise, where we can potentially offer proprietary on-chain products, either through Coinbase's own asset management arm or other asset management or investment management fintech platforms, like Wise, for example. And the third layer is really underpinned by our own efforts on Base, which is the layer 2 protocol on Ethereum. And that's really just the next generation of trading infrastructure, according to us. When you have assets on chain, that live on chain, that trade on chain, that transfer value from one wallet to another on chain, you suddenly remove all artificial boundaries of international finance. So I would say those are sort of the three pillars of how we think about product build, or how we think an exchange should be thinking about product build, to sort of define the future of finance.
That's interesting. I mean, that basically is where exchanges ought to be over a period of time, right? It's where the future is heading towards. Nick, maybe in this particular instance, can you briefly tell us, you operate as a regulated brokerage firm in London and various other parts of the world. So when you hear Sagar describing this vision, what's your immediate reaction from a regulatory landscape, right? So guardrails, regulators do need guardrails that need to be there, but give us your view on that.
Yeah, I mean, from a purely retail standpoint, I think there are large regulatory challenges, and the regulatory landscape at the moment is well, quite frankly, is just a mess. Where the line is drawn between, between securities and other assets, and indeed how the how riskier, more volatile or more illiquid securities are separated from those that are freely tradable and perfectly liquid. That's going to be the big challenge over the next few years for regulators. I think the question really is, should we be allowing all clients access to all products, even if they want them, or is the duty of the regulator and probably the broker as well? Do we have a fiduciary duty to ensure clients understand and that investment in these assets is appropriate for them? That to some extent runs contrary to the idea that or the rush to democratize and broaden access to these markets. There's a clear potential for reputational damage to the brokers and to the investment industry as a whole if we encourage unfettered access to highly risky products. We see echoes of this with Bitcoin at the moment, where it falls 50% in a few months. Large numbers of inexperienced investors losing their life savings. Now, what effect does that have on the broader financial industry? It's not good. The idea that investment is risky is not one it's not one we want to encourage. We want to encourage a full understanding of risk, and a rush to democratize and to fractionalize every available asset is something that really ought to be slowed down by regulation.
Okay, in very interesting perspective. Maybe what we should do is we'll get a little bit into the, from a fintech and a broker's perspective, let's go a little bit deeper, because I think this is where, most interesting strategic decisions are being made as of today. So Kareem, Nick, for fintechs and brokers, what does the tokenization of real world assets actually mean as a product opportunity, right? So when you go out to your retail consumer, what is the opportunity that you see there? Do you see this becoming, at some point of time, maybe, not on an immediate basis, maybe after a couple of years, do you ever see this becoming a mainstream product line? And most importantly, at what point do you think you would pull the trigger and launch? Would you have some minimum criteria that you would want to hit first, or that you think that the whole tokenization concept needs to hit first? Or would you ride the current wave of enthusiasm and go early? Kareem, maybe we'll start with you on this.
Sure. So long story short, we don't see tokenization as a new product category. I think it's just like a new type of instrument. So if you think about ETFs and mutual funds, customers are not interested in knowing what kind of instrument they're investing in. They're interested in what it allows them to do, right? So ETFs allows them to trade intraday, and mutual funds or money market funds that are in a mutual fund wrapper have price stability, right? So basically that's what's more interesting to customers. So the question is, well, what is the value that we would be providing to customers with a tokenized product? Now, there's one use case, which is, I think there's a bunch of players trying to build this, which is, and it's very applicable to Wise, so I'm going to kind of dive a bit deeper into it, is tokenized US Treasuries. So this is a great starting point because it's extremely liquid market. It's yield bearing now with the high interest rates, so it's very appealing to a growing customer base. And there basically the use case of tokenization is going to be instant 24/7 365 settlement. And that's something that many providers already offer or are working towards. So this is very interesting product. Now, Wise specifically, we've actually launched exactly this 5 years ago with the money market fund, and basically placed something on top of it, which is something we call instant access as a feature. Instant access essentially will allow customers to hold their money in multi-currency money market funds that have a T0, T1 settlement time, but we will use our own liquidity to pre-fund transactions for our customers. So essentially, customers can keep their money invested, but still kind of use it whenever they want and have 24/7 instant access. So the question is, how do tokenized money market funds beat this model? And that's really what would allow us, or that's what would trigger us to say, okay, we're going to go and move our from a traditional money market fund to a tokenized one. One of the criteria to moving is going to be economics. So the cost of liquidity of providing the instant access feature needs to be higher than the tokenized fund economics, as well as the cost of liquidity of the fund. And we haven't seen that materialize yet. I think the liquidity is actually quite limited right now, even though it's growing year on year. So that's kind of one of the main blockers that we've seen. The other two that we have also kind of that are going to be a blocker once economics actually make sense is multi-currency support. So within Wise, this is kind of the default. Like, we have customers from all over the world. They hold a lot of different currencies. USD is actually far from being the largest currency there, and we need support in other currencies as well. So right now, all of the efforts are around US dollar, but there's going to be also a need for us to look into others. And then, as Nick pointed to, regulatory clarity is extremely important for retail-facing platforms that operate globally. And unfortunately, there is no uniform framework on this. It's very different market to market, and it's going to be definitely a blocker to releasing this quickly.
Thanks, Kareem. Nick, would you like to add some points on this?
Yeah, so you're playing devil's advocate in part. We can totally see the advantages of speed of your fractionalized money market funds, faster settlement, and an enlarged market. But I think we really need to distinguish between what customers want and what they're actually going to use from our point of view. At the moment, I think that retail customers' needs are pretty adequately served. I don't think there is a great benefit for a retail customer in settling T0 rather than T1. I just don't think they care. So is tokenization going to change the market there? Probably not. In terms of digitalizing more asset classes, I think there's lots of our clients will say, yeah, I'd love to trade artwork or collections of sneakers or whatever. I just don't think they will. I think the sort of pool of investable liquidity is finite. I don't think we're going to drag new money into it. If I think back to my early days in financial markets, one of the biggest, marketing points will be to offer clients access to grey markets and new listings. This got us lots of press coverage. Clients would often ask about it, but hardly any traded it. Very, very few trades we got in these niche markets. And my concern is that it's going to be very difficult to attract new money into niche products. What does that mean? That means there is the possibility that all innovation is going to be tainted with the same brush. I think the situation is different for institutional business. I can totally see institutions wanting to invest, seeing the benefits of T0, of fast settlement, cross-border transfers, hedge funds investing in new and innovative assets. For retail business, though, I think as a marketing tool, I think absolutely, for innovative assets are going to be key. Particularly, as we look at the demographics of who owns digital assets, it's overwhelmingly younger clients in the UK. I think the numbers of people under 30 who own cryptocurrency outstrip those who own shares by 3 times. So that they're prepared to take the risk, but as they gain more money and look to invest longer term, there's a safety in the known, investing what your parents invested in, and that's going to be really hard to change. I think that's probably backed up, again, looking at cryptocurrency holdings, by the fact that more than half of people who own cryptocurrency only own Bitcoin. They don't necessarily want to want to invest in the unknown or the riskier end of things. So yeah, blamed it. There are benefits for institutional, but probably for retail, I think the use case has still to be proven. It may well come. I may sound overly pessimistic here. I should add that we definitely want to be involved, and we're keen to be at the forefront of real world assets. Whether it's going to be worth it, play this match to me in 5 years' time, and I'll be eating my words.
Yep. So I think, thanks, Nick. So I think this is where it's going to get really interesting, right? It's compete or collaborate, right? So this is the big question. And I'm going to try to be a little bit direct on this. When real world assets kind of came on chain, right? Or when they start to come on chain really at scale, one of the most talked about advantages on this is really the sheer penetration, right? So why? Because players like Coinbase alone have over 100 million users globally, right? That is a distribution network that a lot of fintechs don't have today, right? I'm not saying that there is no overlap of customers, but there is a large penetration that exists there. So I guess is this a threat to traditional brokers and fintechs, or is this actually a big collaboration opportunity that we see in the next few years, right? So I guess this is a question which I'd like to open up to all three of you. How easy do you foresee cross-selling, adapting real-world asset products for a crypto-native user base? And how much of a genuine competitive threat does this represent to fintechs and brokers? Are we heading realistically towards a world of collaboration, competition, maybe a bit of both, right? So, Sagar, why don't you start, and then we'll hand it over to Nick and Kareem as well.
I will need to mince my words for this one. I think from our perspective, I am in the bit of both camp. And when you're right, as in obviously we own the distribution channel through our products or through our platform, and that distribution channel today serves over 100 million customers globally. So that's definitely true. And for us, the North Star is to be able to go from a crypto-only exchange into hopefully a global financial powerhouse that is able to serve the needs of retail and institutional customers, clients, partners. So for us, that definitely is the North Star, and that is the reason why we're launching what we're launching, which is the Everything Exchange, which I think some of you may already know about. So I think that's what we're working toward. Now, we also recognize that we will not be able to do anything and everything. We will need to rely on partners. We will need to rely on potential friends in the value chain that we can work with to be able to offer the entire swath of financial products that we are launching or that we've launched. So for certain products, we want to be vertically sort of integrated, where Coinbase wants to build and own the product experience ourselves. And then for certain product groups, we want to just be an infrastructure provider so that fintech platforms, wealth tech platforms are essentially able to plug into Coinbase's crypto as a service solutions, and then broadly offer those services to their end clients, retail or institutional, in local markets where we don't operate. So for us, the answer is not as straightforward. It is going to be more nuanced, where for certain products we want to own and operate the product experience, and for certain verticals we want to be able to provide that infrastructure for partners to be able to offer that up to their end clients in local markets. Hopefully that sort of gives you a good understanding of how we think about where we want to be in the next 5 to 10 years.
Got it. Okay. Maybe, I'll ask Nick a question, right? So Webull has a relationship, I'm assuming, with some players like the likes of Coinbase for their digital asset space. I mean, how would you see that kind of a partnership extending to real world assets, right? Would you use a digital assets exchange as the infrastructure layer as well, or would you want to build an infrastructure layer yourself?
So, I mean, to answer that, yes, Webull does use Coinbase, I believe, in the US, Australia, and Brazil at the moment. I think our point of view would be that we will use we will seek to offer as many products as our clients want and need. How we do that, we'll do it however we can. If it's simpler to go through a partner such as Coinbase, we'll absolutely do that. If it's simpler and more faster to use, to build an infrastructure layer ourselves, that's what we'll do. I think going back to the collaborate or compete question, I think we're in danger of drawing an arbitrary line here. I think we will see changes in the market to come in the coming few years. It might be that Coinbase obtains securities licenses from the local regulators and becomes like Webull. Yeah, what is actually the difference? We're all brokers of some sort. To offer securities products, whether or securitized real world assets to existing users of Coinbase, it just requires a license. So there's probably room for all players. If Coinbase can bring more investors into the market, that'll be something we welcome. They'll go wherever the value is, and we're confident that we can offer value that our competitors won't. So competing, collaborating, I think it's a bit of both.
Awesome. Okay. And Kareem, Wise operates as a...
We should talk more, Nick.
Perfect. So Kareem, Wise operates, more as a platform agnostic provider from an underlying Rails perspective, right? So is that the posture that you would take here too? Would Wise be a distributor of real world asset products, pretty much regardless of who provides the infrastructure underneath, similar to what Nick was saying, or would you want to build it yourself? Would you want to? What would your decision basis be?
Yeah. So I guess if we decided that this adds real value to our customer base and we want to launch it, then it really depends, right? So what we've done so far, for example, is kind of build our own infrastructure, direct integrations with fund managers trading OTC. That kind of works best for us based on our limited range of products. We'd have to look at product breadth and scalability of a setup, liquidity depth of the partner potentially, and also economics before we can really make a decision. Wise does like to build things itself, but this is a slightly different infrastructure to what we are kind of used to building on the payment side of things. So it is possible that we partner as well with an infrastructure provider, the likes of Coinbase, GTN. I don't know. We'll see in the future.
Ankit, I'd like to make a very small point. I think again, without trying to sort of blow my own horn here, or without trying to sort of play, talk my own book. What we have realized after speaking to large institutions, large institutional partners, is also the fact that building for blockchain native, crypto native infrastructure is not easy. It is really, really hard, especially in the context of the security of the assets that you are obviously custodying on behalf of your clients. So what we have also found is that some players, and I know Nick and Kareem were sort of alluding to that, is they just find it beneficial to rely on a trusted infrastructure provider that is able to offer them the peace of mind that comes with knowing that a certain institutional grade infrastructure provider is able to provide the infrastructure as well as hold the assets on their behalf. And then there are obviously certain players who want to own and operate the infrastructure themselves. But then it just becomes a multi-year journey to launch. So it's also a question of whether you want to build it yourselves and wait for 3 years or whatever, how much ever time it takes, or whether you want to sort of launch now and see what the demand looks like.
Excellent. All right. I mean, considering that we have only 3 minutes left, I think we have to do a part 2 of this webinar. But firstly, this has been a fantastic conversation. I really want to sincerely thank Nick, Sagar, Kareem, 3 people who are not just talking about the future of financial services, but are in some ways or form actively actually building it. So the perspectives that each of you have shared today, I think has given our audience a really rounded picture of where real world assets are heading and what it means for all of us in the industry, right? If there's one thing I think that I hope that you're taking away today, it's this: the tokenization of real world assets, it isn't a distant prospect. It's happening. The infrastructure is being built. Regulatory conversations are underway. The question for every fintech and every broker and every exchange is no longer if. I think it's how and how fast, right? So with that, I want to, before we close, we have a few minutes from our audience. If anybody has any questions, please feel free to post them in. Otherwise, we're happy to wrap up. If there are any questions, please let us know. Okay, so Sagar, we have one question. I think this one is probably going to be a little bit more towards you. So we hear a lot about BlackRock and massive institutions driving the tokenization of assets. From Coinbase's vantage point, what is the realistic timeline for the everyday retail investor to start trading tokenized private credit, property, or traditional equities on a massive scale?
It's a really tough one because there are so many different there are so many different levers and so many different considerations that need to go in the right direction for that to happen. So I don't think I can give you a definitive timeline. I can only sort of provide you some considerations to think through, in the context of that question, or to sort of answer that question. So the first thing is, while BlackRock through their Biddle Fund and Franklin obviously have validated the tech, they're still playing in the wholesale sandbox or the bubble of institutional / wholesale. To switch on retail, it's very much still in the infrastructure or the POC phase, as opposed to the distribution phase, because most of the adoption that comes for Biddle, for example, I would argue is largely institutional in nature. Coinbase sort of views tokenization not as a new asset class, but as a sort of almost as a wrapper. And just like ETFs sort of replaced some of these mutual fund products, tokenized assets will eventually replace legacy digital records. But this also requires a massive migration of the back office systems that we are used to. So, for example, I think Nick, during one of the questions or one of the comments he made was, we are moving from T+1 or T+2 to T instant to instant in a few seconds or a few minutes. But that is still a very slow burn. It requires us to update our back office systems in a way that facilitates these types of trades between two individuals or two institutions. So broadly speaking, when I think about like private assets, I'd say private credit is probably the low-hanging fruit. Maybe give it like, I would say 12 to 24 months. These are like high yielding, short duration private credit instruments, and they're already being tokenized, as some of you may know, but still being offered mainly to accredited investors, i.e. investors that draws an income beyond a certain threshold. So it's still not broad access to retail. In terms of traditional equities, you may have seen the news this morning. We obviously launched tokenized stocks in the US, and that is already happening. It's going to be on a massive scale in the US, and then hopefully that sort of trickles down to non-US markets as well. Property real estate is really hard because I think, again, Nick mentioned this point, but liquidity for niche assets, for assets that are not as liquid in the traditional world, we've realized that unfortunately liquidity continues to remain a concern for those types of assets. So I would say give it at least 5 to 7 years before we see light at the end of the tunnel. Hopefully that gives you some view into how we or how I see the democratization of these assets play out and the timelines associated with those.
Okay, perfect. Sagar, we've actually gotten quite a lot of other questions, but I think we will have to end the webinar because we are over time. We will respond to each one of those questions separately, and I'll coordinate it with the panelists. Thank you everyone for attending today's session. It is a recorded session, so we will be sharing the recording with everybody.